Well, moving on to some recent IPOs, Cerebras, a company that got a lot of attention last month for its IPO, has fallen below its IPO price, and it fell as much as 12% just last week.
I wouldn't stress about this too much. I think just my quick take on Cerebras is they initially went on the road. Again, this is about expectations and what have you done for me lately? So showing the last, couple of days without the context is a bit dangerous. But remember, this is a company that priced their IPO at $125 to $135 a share. That was the range they set on the IPO roadshow. They then priced it 185 because it was oversubscribed and the demand blew it, was blown off the doors. I think they top ticked at $311 a share or something after a couple of days because a lot of retail people jumped in and pushed the price up. After the institutional smart money had priced it at 185, the retail pushed it to 311, and then it kind of came back down. And on their earnings call, they had, I guess the good news was they had a really good top line story. So they met all the expectations in terms of their revenue. Q1 revenue was 193.4 million. It's up 92% year over year. No surprises there. And then a little bit of a boof on gross margins, which the expectations on gross margins were 46, 47% going up. And they said, oh, wait a second, the market might have misunderstood the gross margin story. And we might be more like at 36 to 38% next quarter. And, a lot of that is what we just talked about. The cost of compute and the cost of memory is forcing them to spend more than they thought. And they're going to have to lease back some equipment from customers they didn't really expect to do. So maybe temporary, but anyway, those are all negatives. And when they broke issue, the company breaks issue when they trade below the IPO price. There are a lot of sellers in the public markets who just automatically sell when the price goes below the IPO. So if you price at 185 and you go below 185, it's just forced selling. And people were shorting it, I think, in advance of that, trying to get it down to below 185, just kind of gaming the market, knowing that these forced sellers would happen. So they're below the IPO price. Let's see how they do. I think there's a lot of trading dynamics here that aren't long term. This is kind of short term noise, and I would still suspect over the next 6 months, I wouldn't be too worried about them. I think there's still a lot of demand for this stock and these companies for the next 6 to 9 months.
We are hearing a lot about the costs of AI tokens becoming an issue, and I think this probably benefits open source models, open weight models, maybe a little bit more than the top dominant frontier labs. A pretty interesting tweet by Brian Armstrong earlier this week talked about the use of tokens at Coinbase. And you'll notice here that they're seeing that black line is continued use of tokens, but the cost structure is going down as they are shifting to other open source, open weight models for their usage. Slightly related story is that we've been hearing that China has matched Anthropic in cybersecurity, and a company called Z.ai is making available some options for people that are interested in cybersecurity. I think we're kind of seeing maybe that the open weight models, open source models are catching up, maybe not quite as powerful as the leading frontier models, but certainly a lot more economical. Right, Ahmad?
Yeah, I think so. The news out of Z.ai, which is a Chinese company, did suggest that in the field of cybersecurity, I'm not sure they were all the way caught up, but they're getting close. They're like 90 to 95, maybe 98% as effective, but at like 1/5 the cost. And so if you're a CFO looking at how to set your budget, obviously the 95% is good for a fifth the cost, especially given all the constraints we just talked about, is pretty compelling. I think in the area of cybersecurity, though, like companies will pay up for an American best-in-class frontier model. I also don't think I want to hand over my cybersecurity to a Chinese open source model unless I have someone like Perplexity running interference and customizing my security in a way that prevents political bias, personal bias, manipulation from the Chinese government. So this could be a real boon for companies like Perplexity. But there's no doubt that the difference, the value, the gap between what you pay and the value of it, it's getting awfully tough if these numbers are right, which I think they are.
China is producing a good bit of the open source models that are being ranked on top performance. 6 of the 10 models on the leading AI leaderboard were developed in China.
Wow.
I guess last month, Uber burned through its entire annual AI budget in just 4 months and has since started implementing spending tiers. I think we're just hearing more and more people start to shift some of their spending out of maybe the top frontier labs to alternative open source models. And an interesting post by USV, Nick Grossman, who's a partner at USV, is talking about the Rebel Alliance and this idea that there's a large stack of different tools and services at the
Right.
interface layer, at the execution layer, at the intelligence layer that are not just based on, a vertical stack of tools coming from either Claude or OpenAI or Gemini. It's now a lot more companies that are part of that overall stack.
Right.
How do you see this playing out in terms of where AI is growing, whether there's as much dominance by just, Anthropic and OpenAI, or whether there's other players now that are going to start to creep in and take market share?
The Rebel Alliance metaphor of just this ragtag group of warriors that are, that are figuring stuff out and doing it. If it's 90% is good or 95% is good, and 1/10 the cost, I think that works in a lot of areas. It'll work in marketing. It'll work on workflow optimization. It'll be, all the consumer stuff, LLMs. That's why I think maybe OpenAI is more vulnerable to this. There are areas where you don't want to trust the masses. Like, I guess the real world analog is Dunkirk. You don't want to trust the masses who liberated the soldiers from Dunkirk with, cybersecurity or maybe financial reporting, HIPAA compliance, like stuff. There are industries where this really matters. And you really don't, I think you want to trust the British Royal Navy to take the Dunkirk metaphor in those areas. So I think it'll create a lot of pressure on some of the frontier models, especially OpenAI. Anthropic might be a little bit more insulated, but they'll also have to pick and choose their battles as to where they want to play. The more regulated industries, the ones where you can't trust the rebels to figure out how to take down the Death Star. But there's no question the ecosystem is moving towards, it's commoditizing. And as that happens and cost becomes a play, which I think is very healthy for the ecosystem and for startups in general, it's going to put pressure on the frontier models for sure. And that's going to be that has to be their IPO story, is how do they defend against this stuff?
Well, one of those other players is a company called DeepSeek. This is a Chinese frontier model. DeepSeek is raising a new round at a $50 billion valuation. Over $7 billion they're raising at a $50 billion valuation. That puts them in the top list of private companies, right, Aman?
I know. Top 20? $50 billion valuation?
I think even top 10. Yeah, probably top 10.
So we'll cover this one in our valuation corner. But the short of it is they are the leading Chinese open source model. I just reflect on Llama and Facebook and how they completely missed the boat on this. I thought they were going to be the winner, but anyway, I guess DeepSeek for now is in the lead. It's a very unusual round. They raised $7 billion on 50. Only a handful of investors. They're all Chinese. I don't think you can even invest in it. But anyway, they've raised a lot of money, and I think they are right on the heel in terms of performance. They are right on the heels of OpenAI and Anthropic. So it'll be an interesting one to watch.
I find your lack of faith disturbing.
Enough of this. Reda, release him.
As you wish.
Our last story of the day is going to be about a not so exciting and not so sexy IPO. Bending Spoons is raising at a $1.6 billion valuation. And I guess this is a roll-up company, Mom, but can you explain a little bit more about what Bending Spoons is?
They're actually targeting a $20 billion valuation in an IPO. Their last round was $11 billion from Goldman Sachs. The target valuation is actually pretty aggressive. It's an Italian company. It's run by a guy named Ferrari. Not that
Woo.
Ferrari. It is actually just a roll-up of basically internet brands that sound like you remember that graveyard of internet logos that made the rounds in 1999, 2000, 2001 of all the busted companies, dead companies. That's Evernote, AOL. There's all kinds of companies on this list that they've been buying up. The company began as basically a VC-backed tech company that Luca Ferrari launched. I think it was about 6 or 7 years ago. That company failed. He pivoted. He was a former McKinsey consultant, so I guess this made sense to him. And they just went out and started buying a whole bunch of internet brands that they thought they could essentially turn around. So about 8 months ago, they raised $710 million for investment in growth. At that time, their pre-money valuation was $11 billion. And they had folks like Fidelity and T. Rowe Price who led the round. So pretty serious investors. They wanted to basically buy software companies and just run them better. So they had a series of businesses that they had targeted, and they wanted to improve them through operational excellence and make them better. Some of the big ones on their list right now are Evernote and Brightcove. And in each case, they have a playbook that they run. They basically fire a bunch of people, so cost reductions. They do price changes. to basically increase price and improve monetization, and then they just, they kind of consolidate and grind through other operational improvements, whether it's taking out management teams, adding people in, consolidating some of what they do. Interestingly, what you might like about the company and why I think it'll actually be a very successful IPO is their revenue is about 1.3 billion for the full year, but it's growing 95% year over year. Their organic revenue is only 13% year over year, though. So you got to be a little bit careful about thinking about their revenue and growth. Their net dollar retention for the whole portfolio is only 94%. So not exactly best in class revenue growth and net dollar retention, but they are an acquiring engine. They're like a holding company, like Berkshire Hathaway or, somebody like Constellation Software. And they're not profitable, but they are able to acquire and build growth. So I guess the good news is they've got an interesting set of brands. They're adding operational excellence. I'll give you a couple of real concerns, though. They don't have any long-term contracts with their customers. Their subscription revenues really aren't subscription revenues. They aren't really doing ARR. So it's all brand loyalty and can they keep customers coming back? There's no exit value in the strategy that I can tell. They have a lot of debt right now. They've piled on over $4 billion in debt, and their interest expense is climbing faster than their revenues. And maybe worst of all, if you're a CFO, you read through the disclosure of their S1. Actually, it's their F1. They're an Italian company. It's a different thing. But right on page, right here on page.
How appropriate for a CEO with the name Ferrari.
Yeah, exactly. An F1, exactly. The branding is excellent with things like that, but there's a huge disclosure on page 52 about material weaknesses and how they've discovered a whole bunch of material weaknesses and concerns in the financials of the companies that they're rolling up. So I kind of look at that and I'm like, well, wait a second. If you don't have long-term contracts with your customers and you're piling on a lot of debt, and then on top of that, you're telling me that you've got a lot of material weaknesses in your contracts and your financials, I worry that they're just a collection of melting ice cubes. And their organic growth rate isn't great. The question, I guess, for them is going to be, can they compound through acquisition and improvements at a growth rate faster than their interest expense and cost of capital? And I don't know. The truth is, Berkshire Hathaway under Buffett and Munger and Greg Abel have done a good job of doing it. Constellation Software has done a great job under Henry Singleton. I think there's a lot of operational challenges here that these guys have to overcome. But it's an interesting IPO to keep our eye on for the next couple of weeks.